Welcome to This Explainer. So, today we're unpacking something that's honestly a little unsettling about the stock market. You know that perfectly safe retirement strategy that literally millions of us rely on? Well, we're going to look at why it might actually be a highly concentrated trap in disguise. Let's get right into it.
Picture this. It probably feels a little too familiar. Two people check their 401ks this morning. Person A is your coworker. You know the one, right? They will not stop talking about how they're up 92% this year because they went all in on some random AI stocks. Then there's person B. That's you. You did the sensible, responsible adult thing. You bought a boring, diversified S&P 500 index fund years ago. You didn't try to pit winners, and hey, your account is up, just a bit less than your coworkers. And look, if you've been doing this, genuinely congrats, you're winning. But here is the massive plot twist hiding in plain sight. What if I told you that you both actually own the exact same risky bet and you don't even know it? Seriously, if you pull out your phone right now, check your 401k and your biggest holding is a Vanguard 500, a Fidelity 500, or some target date retirement fund, you are heavily invested in those exact same tech giants. You just didn't sign up for it. So let's break down the actual math here. When you buy a quote-unquote diversified S&P 500 index fund today, you are absolutely not getting 500 equal companies. Not even close. Out of those 500 companies, a whopping 35% of your money is sitting in just 7 megacap tech stocks. We're talking NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla. Just to put that into perspective, back in 2016, those same 7 stocks were only about 12% of the index. That concentration has literally almost tripled. To put it incredibly bluntly, your perfectly safe, diversified portfolio has been mathematically hijacked. You basically own a massive, concentrated 7-stock tech bet, and you've got a 493-company hedge sprinkled on top just for decoration. I mean, think about this. So far this year, one single stock, NVIDIA, accounted for a fifth of the entire market's gains. One stock. Driving 20% of the gains for the market your whole retirement is sitting in. Did you actively choose to do that? Nope. The math just quietly did it for you while you were sleeping. Now, concentration on its own isn't always a death sentence. It only really gets dangerous if those few stocks are wildly expensive. And well, right now, they really are. The market's price-to-earnings ratio, which is basically how much cash you have to cough up upfront just to buy one single dollar of a company's profit, is sitting right around 40. For some context, since 1880, the historical average is about 17. Even in 1929, right before the Great Depression, it was 32. So at nearly 40 today, we are statistically sitting in the second most expensive stock market in 145 years of American history. The only time it was higher was the absolute peak of the dot-com bubble. There's another way economists measure this stuff, and it's by dividing the total value of all public U.S. stocks by the size of the entire U.S. economy. Today, that number has hit an all-time record of 231%, meaning U.S. stocks are valued in more than twice the size of the actual economy that produces them. It is exactly like one single restaurant being worth more than the entire neighborhood it operates in. At some point, the math just has to bend back to reality.
So why are things so incredibly expensive? The entire justification basically rests on 2 letters, AI. The market is betting the farm that artificial intelligence will create such insane productivity gains that these prices actually make sense. In 2026 alone, just 4 companies, Microsoft, Google, Meta, and Amazon, are planning to spend a mind-blowing $725 billion on AI infrastructure. Guys, that is more than the entire annual GDP of a developed country like Sweden being spent by just 4 tech companies in a single 12-month window. But when you really peel back the layers here, this whole AI economy starts looking a little bit like a snake eating its own tail. Just look at this chain reaction. NVIDIA pledges $100 billion to OpenAI. Then, OpenAI turns around and signs a $300 billion cloud computing contract with Oracle, so Oracle has to go out and raise $45 billion just to build the actual infrastructure to deliver on that contract. These mega companies are essentially just writing massive checks to each other and counting it all as revenue. Which brings us to the literal trillion-dollar question. What is the actual real-world return on all this massive investment? Take OpenAI, for example. They've committed to roughly $1.4 trillion in spending over the next 8 years, but they're currently only generating about $13 billion in revenue. Think about the sheer absurdity of that math for a second. That is like signing a 30-year lease on a $4 million mansion while making $36 grand a year on minimum wage and just confidently assuming you'll figure it out before the rent is due. And honestly, the receipts for this AI revolution aren't looking too great just yet. A recent MIT study looked at 300 real-world corporate AI deployments, and you know what they found? A shocking 95% of those organizations are currently generating absolutely zero measurable return on their AI investments. Not a low return, zero. We are pouring nearly $1 trillion a year into a technology where 95 out of every 100 corporate deployments aren't even moving the needle on ROI yet. Now, these sky-high tech valuations might be fine if the broader economy was absolutely perfect, but the macroeconomic gravity pulling down on all this is getting really heavy. Sticky inflation hovering near 3.8% has completely forced the Federal Reserve to take expected rate cuts off the table. At a recent meeting, they actually voted 8-4 just to hold rates steady. The Fed is publicly arguing with itself for the very first time since 1992. And let me tell you, that is the closest thing to institutional chaos the Fed will ever show the public. And the bond market? Oh, it is definitely reacting to this. The 30-year Treasury yield recently hit 5.19%, which is the highest we've seen in nearly 19 years. Now, why on earth does this matter for your boring passive index fund? Because when you can just lend your money to the US government and earn over 5% entirely risk-free, suddenly paying 40 times earnings for highly concentrated tech stocks with all the risk in the world starts looking way less attractive. Bond yields are basically the gravity of the stock market, and that gravity just got a lot heavier.
Then you have to add in the government's own balance sheet, which is a massive vulnerability right now. The national debt is over $38 trillion. The United States is now paying more than $1 trillion a year just on the interest payments for that debt. We are literally spending more on debt interest than we spend on the entire U.S. military. Legendary investor Ray Dalio, the guy who runs the largest hedge fund on the planet, recently called this an actual debt death spiral. When someone managing $150 billion starts using phrases like death spiral, you know it's time to pay attention.
But here is where we really need to look under the surface. We are starting to see alarming cracks in the credit market, incredibly similar to what we saw right before the 2007 housing crash. Back then, it was random subprime lenders just quietly failing. Today, same exact tremors. Random, over-leveraged auto lenders are failing. Obscure parts companies are collapsing. And when they go down, they take hundreds of millions of dollars in hidden bank losses with them, stinging these major regional banks completely out of nowhere.
And look, this isn't just some fringe internet theory. Jamie Dimon, the CEO of JP Morgan, the biggest bank in America, a guy whose literal job description is to project calm and stability, publicly compared the credit market to a bug infestation. He said, when you see one cockroach, there are probably more. We probably shouldn't ignore the one guy who has unmatched visibility into the American credit system.
So with all these red flags, record valuations, AI bubble fears, sticky inflation, these credit cockroaches, how is the smart money reacting? Well, almost every legendary investor alive is quietly heading for the exits. Stanley Druckenmiller just dumped his entire position in Alphabet in a single quarter. Michael Burry is heavily shorting semiconductors. And Warren Buffett, his company has stepped back and built a historic, record-breaking cash pile of $397 billion. They are all getting highly defensive at the exact same moment.
Now, you might be sitting there thinking, hey, I'll just sell when things start to actually look bad. But the chief strategist over at Bank of America recently summed up market cycles perfectly. He said, the top is a process, the bottom is a moment. You are not going to get a clean, polite warning bell. The euphoria always drags on. People make money, they brag on social media. Regular folks take out record margin debt and gamble blindly on same-day options. The top is a long, drawn-out process. But the bottom is a sudden, brutal moment.
Because of the fundamental math of passive index funds, we buy into this illusion that we're perfectly safe and diversified. But the reality is you are currently surfing a concentrated, highly leveraged wave. If Nvidia drops 50%, your boring, safe index fund is dropping right down with it. You really have to decide if you want to bet that the music keeps playing indefinitely, or if you want to honestly accept the math and get defensive before the music actually stops.
So what's the play here? The solution definitely isn't trying to do the impossible and perfectly time the market top. Timing the top is a total loser's game. The real solution is implementing incredibly boring defensive strategies to regain the actual diversification you thought you already had. Boring is good here, folks. Look at your allocation. Rebalance your portfolio. Maybe consider equal weight S&P funds where every single company actually has the exact same impact. Look at getting some international exposure, explore bonds. And remember, just holding cash right now pays you around 4% risk-free. That is not nothing.
Neuroscience actually proves that your future self is going to be just as terrified as everyone else during a sudden crash. People don't smoothly sell into a panic, they freeze. So here's the question we want to leave you with in this explainer. Will you look at your investments today, do the incredibly boring work, and rebalance your hidden risks? Or will you just let the math and the inevitable moment the bottom finally falls out make the choice for you? Don't be the last one standing when the music stops. Take control of your portfolio today.